Hi everyone, Natu here again, back with another video. And in this video, I'm here to explain why you should get into private equity instead of venture capital. So yeah, the word private equity and the word venture capital, these are two really interesting words. And broadly speaking, venture capital can be way overhyped. You look at the amount of transactions in the quote-unquote that can be categorized as quote-unquote venture capital, way smaller than the types of transactions that were quote-unquote private equity. Because private equity, it's such a silly term. It's alternative asset management, basically. You have cash, you have publicly traded securities, and then everything else, broadly speaking, is quote-unquote alternative assets. So you enter a whole world, and part of it is the way that people used to do deals in Silicon Valley when the whole tech bubble happened, when it came to hardware and silicon chips and so on. From that boom, the model of investing in very early stage companies and so on, and doing all of that, gained in popularity, throughout going through the going in the 70s, 80s, 90s, and obviously the dot-com boom and bust. So private equity world, leverage buyouts in private equity, it can almost be synonymous, because broadly speaking, in private equity, you're dealing with companies that have existed for a while. You're dealing with deeply revenue generating companies, and much of the discussion is around owning and acquiring a business, and leveraging things in existing businesses, such as cash flow, leveraging assets for the purpose of either merging it, acquiring it and owning it, and using some of that. That's really the purpose for a lot of this, and using that and taking advantage over that. That's what a lot of people love to do, and broadly speaking, all it takes is to find a company that's generating revenue to do so. And so the point is that the reason why private equity is really underrated is really because it got its popularity before venture capital did, and technology enables the new type of growth for companies to grow in valuation like crazy. So basically, the types of returns that people get and the types of time horizons are much longer when it comes to venture capital, because in venture capital you're looking to invest very small amounts, like 20,000, 5,000, 100,000, 1,000, and expect like in 5 years or 2 years or 3 years to exit and the company to scale like crazy. Whereas private equity, you're investing into cash flowing businesses that have millions and like tens of millions of dollars in revenue, or millions of dollars in revenue, or heavy assets, and long history. And if these companies really don't need that, like 20,000 and so on. They already have millions in revenue and wide profit margins. So the types of transactions that make sense for those types of businesses are usually larger. So that's why a lot of investment bankers, family offices and so on, people that consummate larger transactions get into that type of work, because the transactions are larger. And whenever the transactions are larger, consultants come in because they're able to take percentage of fees left and right, and people live off those. And being known for taking, for instantly getting cash flow from a business on day one is it can be much more lucrative than, waiting it out 5 years. And then by the time 5 years pass, then if your investment is good or not. So it's a different game. The time horizon is different. So that's number one, and then number two is obviously, as we discussed, the history. The history is way shorter when it comes to, venture capital, which makes it, really hyped up. The risk profile is also completely different when it comes to private equity, because it takes more sophisticated, it takes, broadly speaking, it takes very niche knowledge to know about the types of transactions you would do for venture capital, because the market size, there's probably 100 billion venture capital deals done, and 90% of that was probably done by one company. Whereas in private equity, you have hundreds of billions or trillions in transactions done yearly, for years. In private equity, it's a much bigger type of game, a much bigger market size. So it's probably deep in the trillions, and there's no way to even measure these things. So, when it comes to the core competencies and the niche, there's more of a niche. Venture capital is more of a niche thing. It's more scarce knowledge compared to the knowledge that comes with private equity. Because when you're dealing with companies that have revenue, you're dealing with like HVAC companies, like train companies, like multifamily deals, factories, plants, things like that, then you're dealing with things that, that already have revenue. And so the domain, you need people who are sophisticated, but it's a way more commoditized knowledge than when it comes to venture capital knowledge, because the market size is so much more huge. So, the risk profile is also completely different, and it can be way lower depending on the type of transaction when it comes to private equity, because you're not dealing with businesses that are pre-revenue. You don't have to bet on a company that has pre-revenue. The company is already making money. And so if you're investing in something that's already making money, you're getting the cash flow, and then you're getting capital appreciation if it gets listed somewhere, or if the company is listed somewhere. Capital appreciation means the value of the securities that you own. And so when you look at the value of the securities you own and it gets listed on the market, then you sell it at a higher price, then there's capital appreciation. Venture capital, most of the focus can be on capital appreciation. Yeah, revenues as well in the long term, but you're looking at mostly capital appreciation, based on like the people who invested in Uber, like 5,000, they're exiting at millions when it went public. So yeah, thinking of all these things and seeing all the ins and outs of private equity versus venture capital, mainly one, venture capital is way newer than private equity, and private equity vastly larger check sizes into companies that already exist and are generating revenues. Venture capital, you're dealing with early stage companies, smaller check sizes, and they're yet to be established. Two, the types of people who would get into venture capital have more niche knowledge, because the types of transactions are smaller, the market size is smaller, and it's more of a niche thing. But private equity is more of a commoditized knowledge base, and the risk profile is way different, because you're dealing with companies, you get cash flow on day one after investments, or you can acquire these businesses on day one. Whereas for venture capital, acquisitions doesn't really make sense in that part of the company's life cycle. And I guess the final point is, I'd say with all these points, I'd say private equity can be more fun, because you're dealing with companies that are already generating revenue. You can use leverage to buy companies. You can raise larger amounts of transactions, larger size of transactions, which contributes to a bigger reputation in representing these transactions. Consult in these transactions, people gain percentages of transactions. And whereas if it's venture capital, generally you're the principal investor, and you're doing it. And you're not doing many transactions unless you're an investor when it comes to venture capital. But when you're in private equity, you want to do many transactions, because they're more doable, because you're dealing with companies that are really mature. And so with this, those are the reasons why I think private equity is way more fun than quote unquote venture capital. Even though people in the software industry, as I was, were really hype, we're really just following the hype. So with this, I thank you for watching this video. Head to raises.com to learn more about what exactly raises.com does and how it helps people raise 10 million plus. And we'll see you in the next one.